Hello, my friends. Let's go to the question of the day. Why do almost no one beat the market in the long run? Welcome, my friends. I'm Fred. Here we talk about business, investments, real life, and training, all from my personal perspective. And today's question is uncomfortable because it forces to face something that most investors don't want to accept. Almost nobody beats the market over the long term. That's not an opinion. That's not pessimism. That's a statistical reality. If you look at a 10-year window, at a 15-year window, and you ask a simple question, who consistently beats the market index? The answer is brutal. Almost no one. Very few individuals, very few professionals, very few fund managers. And when you really understand that, a deeper question comes up. Is it even worth trying? That's the question. Is it smarter to spend your time trying to pick individual stocks, studying companies, analyzing balance sheets, following news, building complex strategies, or it is smarter to focus on making money in real life, improving your career, building businesses, increasing your income, and just put your investments on autopilot? That's the real dilemma. Because even if you do everything right, even if you study hard, if you are disciplined, if you are intelligent, the probability of beating the market is still very, very small. And for professional managers, it's even worse. A professional investor doesn't just have to deal with the market. He has to deal with pressure. He has to deal with clients, with expectations. Imagine a fund manager who believes a certain company is great, but right now that company is going through a bad moment. If he buys that stock and it keeps falling, what happens? Investors panic. They complain. They withdraw their money. The manager loses clients. So, even if he is right in the long term, he might not survive the short term. That's why professional investors often avoid bold decisions. They are forced to think more about reputation than about logic. And that makes beating the market even harder. Now, think about a classic strategy like the magic formula or value investing in general. Sometimes the best opportunities are exactly in companies that are good but temporarily in bad moments. But here's the paradox. If you only invest in companies that are already doing great, you miss the biggest opportunities. And if you invest in companies that are struggling, you have to endure pain, uncertainty, and public criticism. Most people can't handle that psychologically. So what happens? They end up buying what is popular. They end up buying what already went up, chasing performance. And that's exactly how you underperform the market. Let me give you a practical example. Think about companies like Apple, Microsoft, Amazon. Tesla. All of them had terrible moments in their history. Moments where profits drop. Moments where people say they were finished. Analysts were pessimistic. If you were a strict stock picker, focus only on current results, you would probably avoid them exactly at that best possible buying moments. And that's the core problem. The market rewards patience and humility, not ego. Most investors believe they are above the average. Most investors believe they can outsmart the system. They believe that they are the exception. But mathematically, most of them are wrong. That's why I've been thinking a lot about two very simple approaches. If your goal is growth, focus on your work, on generating income, on investing in a diversified basket of ETFs. If your goal is income, focus on your work and build a diversified portfolio of income producing assets. Both strategies are boring. Both strategies are simple. They have a much higher probability of long term success than trying to be the genius stock picker. Now, someone might say, but Fred, if I only buy profitable companies, if I only invest in solid businesses, isn't that a winning strategy? Yes, it probably is. But here's the key question: is it a strategy that beats the index? That's a completely different question because indexes include everything: good moments and bad moments, winners and temporary losers. When you create strict, strict filters, you automatically exclude some of the biggest long term winners. And you don't even realize it. Let me bring this to my own reality here in Brazil. For most of my life, I invested in real estate, building properties, warehouses, commercial buildings. And real estate gives a perfect lesson about this humility I'm talking about. Imagine, I built a warehouse 20 years ago. At that time, let's say I spent 800,000 to buy the land and to construct the building. Today, that same warehouse generates 5,000 a month in rent. If I compare that rent to the original cost, it looks amazing. It's more than 5% per month on the initial investment. An incredible return. But if I compare that same rent to the current market value, the picture changes completely. Today, that warehouse might be worth 1 million. So, now the rent represents only 0.5% per month. Suddenly, it doesn't look so impressive anymore. And that forces a very uncomfortable question. What is smarter today? To keep holding that property, emotionally attached to it, hoping it keeps appreciating, or to sell it and invest the money in financial assets that generate a higher yield right now? That's not just a financial question. That's an emotion question. Because that building, it has history, effort, work, memories. I chose the land. I supervised the construction. I watched it grow in value over decades. Selling it feels almost like betraying part of my own story. But investing is not about nostalgia. Investing is about making rational decisions today, not emotional decisions based on the past. And that requires humility. The same humility required to admit maybe I'm not smarter than the market. Maybe the index knows more than I do. Maybe the simple path is the best path. Most people don't like that idea because when you do stock picking, you feel um, important, you feel in control, you feel like the protagonist of your financial life. Just like when I build a property, I am the one making the decisions, choosing the property, creating something tangible. Buying an ETF, on the other hand, feels boring. You are just one more anonymous investor following the market. No ego, no excitement, no sense of superiority. But maybe that's exactly why it works. Think about Warren Buffett. What did he really do? He bought good businesses at reasonable prices and held them for a very long time. He didn't trade every day. He didn't try to predict the economy. He didn't pretend to be smarter than the system. In many ways, his biggest strength was humility. Humility to respect the market, to wait, to stay simple. And here's the ironic part: most small investors act with far more arrogance than Warren Buffett himself. They trade more, they change strategies more, they take more unnecessary risks, and while having much less knowledge and experience. So, going back to the main question, why do almost no one beat the market in the long run? Because beating the market requires more than intelligence. It requires emotional control, patience, consistency, and above all, it requires humility. Humility to accept that you are probably not special, to accept that the market is bigger than you, to choose a strategy that works, even if it doesn't make you feel like the genius of the moment. That's the hard truth. And honestly, the moment I started to understand that, investing became much simpler. Less ego, less stress, more clarity. So, now I want to hear from you. What do you think about this? Do you believe in stock picking or do you prefer to simply the index investing? Let me know in the comments. Thank you for watching and I see you in the next video.